Assalamu alaikum friends, welcome to day 10 of AFM 14 days revision crash course, and the topic is hedging foreign exchange risk, a topic which you're definitely going to get either as question 1 as a 50 marks or either in question 2 or 3 as a 25 marks question, but you're definitely going to get this question. And the good thing about this is that this is one of the easiest questions. Okay, the topic is risk management, but it is the risk less, it is the most safest question. Okay, the reason is because if you see the past paper, okay, the pattern of this question coming in your exam is almost same. Okay, it has a standard way, this question has a standard way of coming. Okay, they do not unlike your investment appraisal or reconstruction or acquisition and merger, they do not have so much of varieties. Okay, I would even suggest that if you're really good in this, you can even do this as a first question. I mean, you can attempt this question first. So let's start. Here we are going to focus on the past exam history, hedging. These are the derivatives that we are going to hedge. Okay, we are going to use to hedge. You need to know how to work on all of this: forward contract, money market hedges, future contract, currency option, forex swap, currency swap, and bilateral and multilateral netting arrangements. The last one is internal hedging technique. Okay, the others starting from forward to currency swap are your external hedging techniques. In your AFM exam, most of the time at least 3 to 4 derivatives you will get. So this is how the question is set. They will give you 3 to 4 derivatives. They will either give you a foreign currency receipt or a foreign currency payment. You have to hedge using all the 3 or 4 whatever it is given, and then advise which is the best hedging technique. To advise which is the best hedging technique, it's not always based on the financial terms. You have to give advantages and disadvantages also. And most of the time it has been seen that forward, future, option always comes. Okay, these are the three that always comes in the exam. And sometimes swap, sometimes bilateral and multilateral does not come always, but it did came in the past paper, I think 2 or 3 times. Few times it came, but forward, future, and option are the most frequent ones. Okay, for currency. And mind you, the same thing is going to be there for interest rate risk management also, which is the next, which we are going to do in the next day. Next video will be on that. This is currency. That one will be interest rate. There also we are going to go through future, option, forward, swap. But the way you do it will be a little different. Not so much of difference, little difference only. Okay. Because here it is currency, we have to deal with two. There it is interest, only one interest rate. Okay. So let's start with past. If you see the past exam history, you will see that it comes, it's like a mixed. Okay, it equally comes in question 1 or 2 or 3, but as I can see it's mostly in question number 1 that it comes. I can see from this one 1 and 2, like in September 18 it was in question 1, December it came in question 1 as well as 2, but it comes almost, you can see the frequency right of it appearing, it comes almost in all the exams. So now you can understand how important this topic is. Starting from discussion on foreign hedging, netting and matching, it came once. Forward, money market, OTC option, future, traded options comes. Currency swap never came. Okay, because there is not much also to ask on that, but we'll still learn it and keep. So starting with hedging. Okay, to hedge. Okay, what is hedging? In my earlier video, we went through what is hedging, right? It's a form of risk management where you have various financial derivatives to hedge, like forward, money market, future, option, like that. Now you need to know that risk can be divided, the foreign exchange risk can be divided into three. Okay, sometimes this is also asked as a discussion question: what type of risk it is, can you hedge it? So there are three types of risk. Number one, transaction exposure. Exactly, this is what we are hedging. That foreign currency receipt, foreign currency payment we are doing, right? That's a example of a transaction risk only. Because we are having transaction with foreign companies only, we are exposed to this risk. That is transaction. It's a short term, it can be hedged. Second type of risk is translation. Translation means when you translate the financial statements. Let's say the financial statement has been made into subsidiaries currency. Now you want to translate to parents currency. So that will have some differences, right? Exchange differences will occur. That is a risk. Okay. Either it could be a gain, exchange gain, or an exchange loss. But that term is called as translation risk. Even if you have no transaction, you still will face this risk because you have to translate. That's why it's also accounting expense. For the purpose of accounting, we record it as an expense. Third one is economic exposure. This normally we cannot hedge using our derivatives, forward, future, and option. Why? Because this is a long-term risk. This often occurs because of the changes in the economy. Maybe the competitiveness of the economy went down. Government imposed some restrictions which made that currency unattractive, or the environment, the economy is not doing well. So there could be so many reasons, but it's long term and it's hard to hedge it. Okay, so these are the three types of risk, and the risk that we are hedging is transaction risk. Now, before you touch the external method, remember sometimes this is not always. In the exam, you might have 3-4 payments or receipts. Okay, and if you see 2 or 3 payments or receipts might be in same currency. So what do you do? What you need to do is before touching forward future option, you first need to hedge it using internal method. Always the priority should be given to internal method first and then external method. Internal method only when you can net off against each other, or you can match the assets with the liabilities. Otherwise, no need. You can directly go to external. It's not always that internal methods are used. Okay, I'm telling you this before. Otherwise, you'll keep searching which internal method to use, which internal method to use. But if there is, you have to hedge using internal method. Okay. So these are some internal methods. Invoicing in home currency. You can tell the foreign supplier or the customer to invoice in your home currency, so that when they give you the invoice, it's in your home currency rather than in the foreign currency. That's an internal method. Second, leading and lagging. What is leading and lagging? Leading means you are making the payment early because you are scared that in the future the foreign exchange will be unfavorable to you, the moments. Lagging means you are delaying the payment because you think you can reduce the cost maybe by paying late. Leading is paying earlier. Lagging is you are delaying the payment in foreign currency. Okay, leading and lagging. Matching. You are matching the assets with the liabilities in the same currency so that it net off against each other. These are internal methods. Let's say you have a payment of 1 million, receipt of 500 in the same currency. So why to hedge 1 million separately, the payment, and 5 million receipt separately? Net them off against each other. So you will be 1 million minus 500, 500 net payment you will have. So hedge that 500 net payment, 500,000 net payment. Okay, it reduces your cost also. Now we are moving to external method. In the external method, these are the methods: forward, money market, currency future, currency option, currency swap. We are going to start with the forward first. Forward is one of the easiest. Why? Because you are just given one rate, use that rate, convert it, and done. Okay. So forward means either you can buy or sell a currency at that fixed rate. Simply that is the meaning of forward. Okay. And this is most of the common form of hedging also. But not all the time market exists for forward. You have to consider whether a market actually exists for forward or not. Now, advantages, and see, every hedging method has disadvantages and advantages, and you have to know it because you have to write this in your answer. When you are deciding which is the best hedging technique, you are writing these advantages and disadvantages. Now, the question is how many? How much should I write? Not all the advantages and disadvantages, you know. Maybe one or two is enough. right? More than that is not required actually. Depends on the marks, because most of the marks will go for calculation. So very less marks are remaining for the discussion part. Maybe 6 to 7 marks, and you have to cover all. It's not just only forward you are writing and for others you are not writing. No, if you have forward future option, all the three advantages disadvantages you have to write. So maybe writing one advantage and one disadvantage of each is enough. Okay, that shall give you enough marks. And finally your conclusion itself is 1 mark. Okay, and finally what you choose is up to you. This can differ, okay, based on the justification that you have given. There is no right and wrong answer. Some of you might say forward because it is giving the lowest cost, it is easiest. Some of you might say option because you can take advantage of favorable exchange rate. Some of you might go for future because it is in between the two. So anything could be your answer. Okay, never panic, never try to fit in that one box. Never think, oh, because others got forward I also should have written. No, everyone has different answer, but provided you have given the justification you will get the full marks. And that justification means advantages, disadvantages, and your calculation, obviously, of course. If it's a payment, you will choose the lowest payment. If it's a receipt, you will choose the highest receipt, right? That is only on finance. But if you want, you need a more balanced answer, you have to talk advantages, disadvantages, combine them with your financial, with your calculation, and then give a proper conclusion. Okay. So advantages of forward is OTC. What is OTC? OTC stands for over the counter. Okay. OTC stands over the counter. That means whatever the receipt or the payment you have, you can actually match it with the forward because it's like customized. Unlike future and option, they are standardized. Okay, because you have limited options, limited future, you have limited option and limited future. Okay, for a fixed currency. Let's say you want to hedge 500,000, 20,000, but the market only is for 500,000. That is the lowest in future and options if you go. But forward is not like that. You can exactly hedge the amount that you want because it is customized. You can, like, over the counter. Okay. Second, it is very simple and easy to understand. It is simple and it is easy to understand. Disadvantages is availability. We earlier went through this. Forward might not be available sometimes. Second disadvantage is it's binding. No matter what happens to the circumstance, it's a binding contract for delivery. So you're bind. Next, disadvantages. This is also for others except options. That is that it eliminates exposure to the upside also. It's true that it is going to manage your risk, but you cannot take that advantage of favorable exchange rate. If the exchange rate goes the other way around, okay, you cannot take the advantage of that benefit. But in options you can do. Only in options you can do this. That's why option is the most expensive. For future does not have that. Forward does not have that. Okay, so it eliminates the risk both the sides, upside as well as downside. Next is money market hedge. Money market hedge only comes in currency. It does not come in interest rate risk management. In money market, you are dealing with interest rate only, basically, of the two currencies. Okay, that's why they say that interest rate parity says that money market should give the same result as forward, because forward rate is what, it is nothing but difference between the two interest rate of the two currency, right? That's how you get the forward contract. So according to that, money market hedge should be same to forward based on interest rate parity. So this can be used for some currencies where forward contracts are not available. Remember, money market can be used where forwards are not available. And this may be difficult to use if the firm has cash flow problem. You are dealing with cash. You are making deposit in some currency. You are borrowing in another currency in another interest rate. So basically you are dealing with cash flows. You need lots of cash. If you're having cash flow problem, money market hedge will be very difficult for you. Now, for you to know in what currency to borrow, in what currency to invest, I have made this table. This will make it very easy for you to remember. Okay, because it's fixed. So the question you need to ask is whether it's a payment or whether it's a receipt. If it's a payment, always if it's a payment, foreign payment, you always number one, invest in foreign currency. Invest in foreign currency. Second, convert. Second step is similar for both actually. Only the first and the third step are different. Okay. So invest in foreign currency, convert to home currency, third, borrow in home currency. Now, why did I give you this step like this? Why did I first start with investment? Your textbook might give you a little different answer to this. Okay, I did follow the textbook to be honest. I followed what I used to do because this is one of the easiest thing. Why? Always start with foreign currency. Why? See, in your question, in your exam, you are always given a foreign currency only. True? Always you are given a foreign currency only. You don't know what is how much you have to borrow, how much you have to invest in home currency until you convert. You understanding? So home currency will come at the end only. Whether it's a payment, whether it's a receipt. You don't know your home currency. You first have to convert it. But at least the foreign currency you know. Whether it's a payment, whether it's a receipt, they will always give you foreign currency. So your starting point is foreign currency. Okay? This is how I have made this thing. Now I'm telling the logic behind this, okay? Because textbook is different. If you go to textbook, you'll be a little confused why this is like this and why that is like that. I have made this on my own. This is not from any textbook. So you first start with foreign currency. Starting with foreign currency means if it's a payment, invest. If it's a receipt, borrow in foreign currency. So, but starting point is always foreign currency. Second step is always conversion. Convert to home currency. Convert to home currency. Step 3 is always the opposite of step 1. Currency has to be different. There it was foreign currency, now it will be home currency. So you invested in foreign currency means you have to borrow in home currency. It cannot be same. You cannot invest in foreign currency and invest in home currency. No. You invested in foreign currency, then you borrow in home currency. For a payment. At least remember one thing very well. If you cannot remember two things, if you're finding it difficult, I always say this, and I always used to do it myself, at least learn one thing very properly. So that the next thing you get, is just the opposite. It's just the opposite of it. That's it. So if you know the payment very well, receipt also you will know. If you study receipt, payment is the opposite. Now, let's go to receipt. Receipt is you invest it for it. Sorry, you borrow it for it currency. Okay. If you see it's opposite to step 1. There you invested, here you borrow. But foreign currency, foreign currency. That's the same. Step 2 is same for both. Step 3, payment you borrowed, receipt you invested in home currency. Sorry, there is a change in my voice a little because I got cold and I'm finding it very difficult to even speak. But as you know that exams are near and I just cannot waste any more days. I definitely know how important these videos are for you and you definitely did it. So that's why. So I apologize for that, for my voice and this, but there's no other way. So do not forget one more thing. That's time apportion. Time apportion your investment and borrowing rate. Why? Because they always give you annual rates. They will tell you borrowing rate is 3%, investing rate is 5%. That's annual rate. When you are taking the payment and the receipt, you are taking it for a certain portion of time, like 3 months, 4 months receipt, 3 months. Always you have to time apportion that annual investing and borrowing rate. This never forget because most of the students forget this. They take that annual rate itself. No, you'll be given two rates: annual, sorry, investing, borrowing. Okay, you have to choose very carefully which currency you are investing, which currency you are borrowing. That's how you have to pick the rate. This is easier now because I've given you the table now. Just use it for a payment, for a receipt. Step 1, 2, 3, step 1, 2, 3. Never forget this step. That's all you need to know about money market hedge. That's it. This diagram only you need to know. And you understood money market hedge completely. Next step is do questions. That's it. Okay. So now, future contract, okay, from money market future contract. I'm not doing questions because I told you this is just a revision, quick revision, very short revision, 30 minutes video each. Questions, revision kit solutions, I've done it before, you can check. And also, when I explained it in my lecture, I must have solved some questions, so there also you can see in my AFM lecture. Now future contract. Future contract, okay, they are basically forward contract that is traded on exchange, okay, or it's like it is traded on exchange. It's not customized. Everyone will get the same future in that currency. It's limited. It is standardized. It is not customized like forward. It's not OTC. You will not get over the counter future, right? So that's why you see that all the future contracts, they are assumed to expire at the end of this 4 months. What is it? March, June, September, December. And coincidentally, this is also in your with your ACCA exams also, if you see, right? Isn't it? So you will never forget it. March, June, September, December. Even your ACC exam sessions are also in this 4 months. And it expires at the end of each month, 31st of March, 30th of June, 30th of September, 31st of December. Okay. Now, third point that you need to know about future, range of available future is limited. I told you before. Okay. Fourth, exam question gives the contract size. You don't have to worry about the contract size. Exam question will give you always, both for future and option. And whenever you are given a question where you have both future and option, contract size is same for both. This is another advantage and is a time saving. That once you calculate the number of contract for future, same you can use it for option. You don't have to calculate it twice. Now, what you need to know is the lock-in rate. What is lock-in rate? Lock-in rate is, okay, it fixes the exchange rate. Okay, the rate should be fixed at this. This is a shortcut, by the way, in your exam. You always have to find a closing future price. See, you are given the opening future price, closing future price, you always have to find out. Okay, we'll come to that later. But in your exam, you are given a shortcut in order to save time. In case if you forgot, what is that shortcut? This is the shortcut. Remember it. Remember the shortcut also. Opening future plus unexpired basis. If you do not know the spot rate that time, you can use the unexpired basis. This you must have already calculated it. Unexpired basis. You should know how to calculate unexpired basis. So opening feature will be given to you. Unexpired, you calculate, add both and get the, that is your closing future price. Lock-in rate means closing future price. That another term is lock-in rate for that. Now we have some calculation. Just give me a minute. Okay, so I'm back. Now there are some steps that I've created for you for calculating future questions. Step 1. There are 3 key questions that you need to answer in your exam. Number 1. Do we buy or sell future? Depends. Depends. How? If it's a foreign currency payment or a receipt. And also in which currency the future is at. Okay, if you want to buy dollar and the future is also in dollar, you will buy future, right? So it's like that. Second, how many contracts? This contract size will be given. Okay, you have to find out. Which expiry date? Is it March future, June future? You will be given multiple futures. You have to decide which future. Again, it depends on your hedging period and also the expiry date. The closest expiry date to that hedging period when you are choosing the future. Step 2. You contact the exchange, you pay the initial margin, okay, and then wait until the transaction settlement date. Step 2 basically you can ignore. Step 2 is only you have to do when you are told to do questions on maintenance margin, initial margin, market to market. Only if this question is asked you do step 2, otherwise step 2 you can ignore and come to step 3 directly. That is calculate profit and loss in the future. Remember, if you are getting a profit in future, you'll be getting a loss in the open market, spot market. If you are getting a loss in the future, you are getting a profit in the spot market. It's always the opposite. That's how it offsets each other. Okay. So you close the future position. If you are buying the future, now you sell the future and find the profit or a loss. Okay. And then you calculate the value of the transaction in the spot using the spot rate also. And if it's a profit, you add the profit. If it's a loss in the future, you deduct the loss. That's how you get the overall net position, right? Now coming to currency option. Currency option is a right, not an obligation, to buy or sell a currency at an exercise price. This is more expensive than forward and future, as I told you before, because it gives you flexibility. You can take the advantage of favorable exchange rate by not exercising the option, and when the exchange rate is not favorable, exercise the option and reduce the risk. That's why you have to pay a premium for it, and premiums are very expensive. Third, you can have exchange traded options or OTC, over the counter option. Same like forward. Forward is not usually exchange traded, but options are. Currency options can be cash options or options on currency future. Okay, could be anything. See, you don't have to know all this definition. This is just I'm giving an overview of currency option. That's it. You don't have to write all these points in the exam. It's not needed. Just understand and go ahead. Same like future, we have here also step in options. In future, we have 3 key questions. Here we have 1 additional question, 4 key questions. First one is here also call. There we have buy or sell. Here we have call or put option. Call means to buy, put means to sell. Again, depends whether it's a foreign currency payment or a receipt, and also in which currency the options are. How many contracts? Same as future. Which expiry date? Also same as future, because option is also like that. March option, June option, September option, December option. Which strike price or exercise price should be used? You might be given multiple exercise price, and you have to choose the exercise price which gives you the lowest net payment or highest net receipt. How do you do that? Just take your exercise price and deduct the payment if it's a receipt, and if it's a payment, add the premium with the exercise price, whichever is giving the highest payment, highest receipt and lowest payment. That should be your exercise price. But mostly in your AFM exam, they just give you 1 exercise price or 2 exercise price. I think it's 1. So where they are giving you just 1 exercise price, just go with it. Okay. There you don't have to do all this. And usually they will not give you more than 2 exercise price actually. They have never given it. Step 2. You pay the premium. Contact the exchange, pay the premium. Okay. So in step 2, basically just calculate the premium. That's it. Step 3. Same like future. There we calculated profit and loss. Here we are going to see whether we are going to exercise the option or let the option lapse. I'd compare it with the spot. I always compare it with the spotted, whether it's future option. Okay. And finally your net position. Net payment or net receipt. Step 4. Calculate the net cash flow. Remember, be aware. Sometimes in number of contracts, you might not get the exact number of contract. You must have to round. Okay, so if the number of contracts need rounding, let's say you are having 41.6, you are saying 41 contract, you are using less contract, right? The balance needs to be hedged somewhere else. Okay, so there will be some exchange at the spot rate. So those balance you can use, you can hedge using spot rate, even if the option is exercised. Because you didn't entirely use 41, it's not possible that you can use 41.6 contract. It has to be 41 or 42 contract. Let's say 41 contracts you have used. So answer is 41.6. So the balance 40 minus 41, 41 minus 41.6, that's 0.6 needs to be hedged using spot rate, even if you have exercised the option. Okay, or you can use forward for it. Now coming to Forex Swap. Now things are a little easier because the hardest thing we have finished, the main three things we have finished: forward, future, and option. Oh yeah, money market as well. Now things are a little easier. Forex swap. There are two swap: currency swap, forex swap. Please understand. Forex swap is a agreement between two parties to exchange cash flows. Okay. Forex swap involves swapping and reswapping of agreed equivalent amount of currency at an agreed date for an agreed period. It could be called fixed rate for a fixed rate. This allows, why do we go for swap? Because it allows you to hedge for a longer period of time. Forward is only for short period of time, but forex swap is for a longer period. That's an advantage. Second, it is also useful where exchanges are very volatile, where there are exchange controls or volatile exchange rate, because you don't know at which side exchange rate will go, right? In that, swap is helpful. Now, so usually we don't have any question on forex swap, so we cannot include it any as an example. Coming to currency swap. Currency swap means swapping of interest rate commitment on that borrowing in different currency. Okay, this includes two things: swap and reswap of the principal amount as well as the interest rate, because you have to pay too, right? When you're taking a borrowing, it's just not the principal, interest rate also you have to pay. That interest rate also you can swap, reswap. Okay, so this is fixed for fixed or fixed for variable, the swap of the interest rate. For further reading, on your ACCA website there is a technical article on currency swap. Please go and read it. It will give you a greater idea. Now coming to the last, which is an internal hedging technique: bilateral and multilateral netting. Okay, for this you have to use a tabular method. In tabular method, step 1: set up a table. You don't have to do a table actually, you can use your Excel for this. Okay, but let me tell you the process. Set up a table with the name of each company. This will be given to you, who is paying to whom. So the company of each name down as well as across, sideways, horizontally and vertically, the same company only. Okay, step 2: put all the amounts, who is going to whom. Okay, and convert them into one common currency. They will examine, like the questions will tell you in which currency, maybe dollar, maybe pounds, what is that common currency that it needs to be converted at. Spot rate also will be given to you. You just have to know how to convert. Sometimes you might have to use the mid rate between the ask and the bid price. Okay, be careful what rate they are asking you. Step 3: you add across, you add downside. That means you will get the payment and you will get the receipt, total payment and total receipt. Okay, and step 4: finally deduct all your receipt payment from your receipt and find the debt payment or a debt receipt. Okay, further reading. For this also you have, on your ACCA website there are two technical articles. One is known as, the name is Exchange Traded Foreign Exchange Derivatives. How to answer a foreign exchange risk management question. Very important for your exam. In detail is there. Please go and read it. So for this, that's it. Thank you for watching. And next is hedging interest rate risk. This is the last on your risk management before we go to mergers and acquisition. Thank you for watching and don't forget to subscribe to my channel if you haven't. See you in the next video.